Good afternoon, everyone. Thanks for joining us for Practical and Tactical Actions for Small Business Owners. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CFP, CIMA, CPWA, CIMC, RMA, CPE, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. Let's get started. Our instructor today is Mary Reed, Pentegra's National Director of Pension and Protection Planning. Mary is a specialist in qualified tax advantage strategies for small business owners. She keeps those business owners turn a good year into a great year by keeping more of what they have earned. Mary, I'll turn this over to you to start talking practical and tactical actions.
All right, thank you very much. All right, so our agenda for today is we want to cover some basic topics here: how to help business owners keep more of what they earn, what you need to know about some of the recent changes of the Secure Acts 1 and 2. We'll discuss some of those items. Talk about what's been happening at the state level. We have a lot of plan mandates hitting at the state level and how that can affect employers. How can employers limit their liability relative to their retirement plan? There is liability that comes along with the benefits, so we'll talk about how to protect employers from that, how to take better care of key employees, and maybe from this, how to get a better and more productive workforce as well. Qualified plans and non-qualified plans together can do all of those things. So our objective, hopefully by the time we get to the end of the hour, you'll have a little better understanding of how to use retirement plans to achieve the business goals that those business owners have, understand some of the key provisions, not everything, but some of the key provisions of the Secure Acts, learn some of the elements of the plan governance process and what keeps a plan in compliance, have some basic recognition of executive compensation arrangements, which are non-qualified arrangements, and also a look at how we can help with the financial well-being programs for employees. So let's start with, how can I keep more of what I earn as a small business owner? Something all small business owners would like to do. And a qualified plan can help do that, right? Because what does a qualified plan do? It gives that owner deductions. So for those owners who are profitable and have cash flow, if they're sitting with their CPA at the end of the year and they say, have you gotten me every deduction you can? And they have not looked at a qualified plan, then that answer would be no. So for small business owners, there are many different plan designs available that can help them achieve their personal goals. You know, this is about custom designing. What are their objectives and what is it they want? Most small business owners are unaware of all the different options that are out there for them. They just haven't been exposed. People haven't told them, so they don't know what their options are. There's a wide range of options, everything from, you know, single IRAs, to simple IRAs, SEP IRAs, all the way through to defined benefit plans and profit sharing plans with new comparability. So there's a wide range with a wide range of contributions. So our job, you know, when we design a plan for an employer is to look at what their objectives are, understand what their company looks like, and to design a plan that gets them as close to their objectives as possible, staying within the rules of the law. So to do that, you know, what is the objective? How much cash flow do they have to work with? How big of a deduction do they want? Employee demographics are important. Every company looks different. So we need that information, and then we go to work and try to meet those owners' objectives. So here are some of the different types of plans, just kind of a snapshot. You know, kind of at the simple end, not to pun intended, but we have SEP and simple plans. These are IRA funded plans. When an employer adopts these plans, money goes directly into IRAs for the participants. Then on the right side here, we have the true qualified plans. These are under a different section of the Internal Revenue Code and have different rules. So on the SEP and simple IRA, any business can establish a SEP. And when I say any business, it doesn't matter what their legal form of business is. Sole proprietors, partnerships, LLCs, sub-S corporations, C corporations, all have the same plan options. There used to be a time when it was different, but it's been a long time. So they all have the same options. They could all adopt a SEP. A SEP is all employer contribution. The limit on that employer contribution is 25% of the total payroll of everybody who's in the plan. The maximum someone could get in a SEP is $69,000 for this year. For 2025, that number has been moved up to $70,000. So they have to have enough income that 25% of that income will get them to that limit, but that's how much somebody could get. Now, a simple IRA is different in that this now has salary deferrals made by employees. This is kind of a simplified version of a plan that looks like a 401k because it has salary deferrals. These are only available to businesses with 100 or fewer employees. You cannot have any other plan in a year in which you have a simple plan. The employer contribution, there is an employer match here based on, so employees can make an additional contribution up to $5,000 over and above the salary deferrals here. So the salary deferrals were $19,500 for 2024. Goes up to $20,000 for 2025. That and the employer, and there is a required employer contribution here, altogether cannot exceed $39,000 this year for one individual or $40,000 for 2025. So small employer contribution limits that apply for simple plans with 25 or fewer employees and simple plans with 26 to 100 participants. If a 4% match, you top out at 3%. So just some intricacies in the rules. Just understand it's a salary deferral, less salary deferral than a 401k, and there is a required employer match here. So then we move on to the true qualified plans. So the most common plan that we see out there are 401k plans. 401k plans allow for salary deferrals by the employee and also an employer contribution. That employer contribution might be a match, might be a profit sharing contribution. The employer contribution is limited to 25% of payroll, just like the SEP is. However, now we have salary deferrals in addition to that. Deferrals for 2024 topped out at $30,500 and $31,000 next year. The most an employee could get, and this is if they're 50 or older, right? If they're 50 or older, if they're under 50, they have the same $69,000 maximum that the SEP had. But if they're over 50, they get the additional catch-up on top of that and could go to a maximum of $76,500 this year. Next year, that number goes up 1,000 to $77,500. Now, you could do a 401k with profit sharing and employer contributions, or if an employer wants to, they could do salary deferral only. Again, we have the salary deferral with the catch-ups for 2024 is $30,500. That will be $31,000 for 2025. You have to pass testing to do this, but if an employer wants a program for their employees but is not in a position to make employer contributions, they could do that. Then we step up. If someone wants more than that, $69,000 or $76,500 with the catch-up, and they have the cash flow, we start to look at defined benefit plans. These plans do not limit the contribution. They limit the benefit that can ultimately be paid, but the contribution is whatever is actuarially required to fund that benefit. So this is completely employer funded. These are not salary deferral plans. It's completely employer funded. We can see contributions much greater than that 25% of payroll because we do not have that limit anymore. And so at the individual level, we could be much higher than that $69,000 or $76,500. Sometimes we'll see contributions here for an individual that might be $200,000 or $300,000 if they want to go that high. So the difference being a 401k plan defines the contribution. How much your benefit will be when you retire, you have no idea. It all depends what the investment performance is and how much you put in. Defined benefit plans do just the opposite. They define the benefit that you will receive at retirement. and the amount of contribution each year will be determined by actuarial calculation. So how much do you want to contribute? So if we're talking to an employer and they're looking at just up to $7,000 and they say, I don't want to do more than that, well, then they could just do an IRA. If they wanted to do up to $22,900, or if they're 50 or older, $24,500, now we might go to a simple. And we have a 2% non-elective employer contribution in here as well. And in the simple, you could do that or the match. And you see those numbers are a little bit higher for 25. If they say they want to go higher than that, well, if we go to a true 401k, we can have a salary deferral of $23,000 for someone who's under 50 and someone who's 50 and up. Now we're at $30,500 instead of $24,500. And then the employer can also do a contribution here, whether it be a match or an employer contribution. So we're stepping up in the numbers here. If someone wants $69,000 and they have a high enough compensation that 25% of their compensation will get them that, then maybe a SEP is what they want. If their compensation is lower, by the way, and they want to get to that $69,000, sometimes a salary deferral in a 401k plus an employer contribution might be able to get them to that $69,000, even if their compensation is not as high. If they really want to, get to the full maximum, do a 401k with a profit sharing contribution to get them to the absolute maximum. And if they want to go over that 69,000 number or 76,500 with the catch up, now we're into defined benefit plans. And looking at, there are a variety of different types of defined benefit plans and looking at the contribution potential there. So cash balance plans are probably the most popular of the defined benefit plans that we're seeing today. These have really taken over in the marketplace in the last, maybe 7 years. So this is a type of defined benefit plan. So it has those same potential high contributions as any other defined benefit plan, and it's all employer funded. However, the difference here is the way the benefit is defined. In this plan, the benefit is defined for each participant as an annual contribution credit. That could either be a dollar amount or a percentage of pay. There will also be an interest credit credited to that employee each year. So it looks like an individual account, but it isn't really an individual account. It's an individual account on paper, but the funding of it is really a pooled account behind the scenes, just like any other defined benefit plan. So what makes these plans particularly popular is that we can divide the employees into different groups and give them different contribution credit percentages. We get a great deal of flexibility and leeway in these plans that we can't get in other kinds of plans. So we get this flexibility and combined with the potential for these much higher contributions, and that can be a very attractive option for some business owners. So how do these plans work? So first, a TPA or an actuary will look at the employee census and do a design for the plan based upon what the employer's objectives are. Once we have a design that business owner wants, we create a plan document. We have to write a plan document. That's what creates a qualified plan. Then we have eligibility requirements that'll be written into that document. So now, what employees meet those eligibility requirements, they will come in. Calculating their benefit is dependent on what their compensation is. So if it's a corporation, we're looking at everybody's W-2. If it is a pass-through entity, it'll be W-2 for those employees who are paid on a W-2, but for the owner, it will be their pass-through income. The actuary will look at what the benefit formula is in the plan, who's in the plan, what their compensation is. So what's their benefit for the year? What's their formula under that contribution credit? And then how much actuarially is required to be contributed to fund that. The employer will be given a minimum amount they must contribute and a maximum amount they may contribute every year. The plan trustee who directs the investments can invest that money pretty much any way they want. It's one pooled account, and the TPA will do all the record keeping and actually keeping track of each individual participant's actual benefit, and also doing all the compliance testing and reporting work. So a winning combination, when you look at these cash balance plans, you will see they are almost almost always combination plans. If we combine a cash balance plan with a 401k plan, we can test those two plans together. Now, it is really two separate plans, but for testing purposes, they're combined. We get better leveraging on the testing that way. And so for the most efficient plan designs that most employers want, which means maximizing those people they want to and minimizing those that they want to get the minimum amount to, this combination is usually the most efficient design. So how much can we actually contribute in these plans? Well, depending on your age will drive the numbers. The older someone is, the higher the contribution will be. So let's start with our 35-year-old here. They can make $23,000 of deferrals into a 401k plan. With the profit sharing contribution added, they could potentially get a total of $69,000. The cash balance maximum benefit, their contribution credit for that year would be $91,000. So they could have these two plans together, maximize them both with the deferrals, the profit sharing, and the cash balance, and get a total of $183,000. Obviously significantly higher than the $69,000 they could have done just in the profit sharing and 401k. But look what happens as we get older. Look down to our 65-year-old. Now their deferrals are $30,500 because they picked up that extra catch up because they're over 50. Their profit sharing now, they get the $69,000 plus their deferral, but now they get that $7,500 on top. So they're up to $76,500. Look at their cash balance contribution credit, $329,000. And so their total is $436,000. Now, can everyone afford $436,000? No, but some companies can, and some companies are looking for those very big deductions and those very big contributions for usually the business owner. Sometimes they have a couple of other people they want to benefit as well. So, so for 25, those were the 24 numbers. For 25, we're going to bump up a little bit. Now we're up to $77,500. Now we can give the 65-year-old $444,500. Everybody's numbers just bumped up a little bit. That's the cost of living adjustments we have for 25. So how will the funds be invested in this plan? As I said, it is one pooled account. When the actuary does their calculations of what the contribution needs to be to keep up with the benefits that are funded, they have to use an interest assumption of what they think that money will grow at, what rate into the future will that money grow at, and they're controlled by regulations. They have to use treasury rates. So typically, right now they're using about 5%. So, and also will have an interest credit applied to everybody's benefit that they'll receive as part of their benefit every year. And typically that could be a fixed percentage, it could be market rate. Typically it's 5%. Under the Secure Act, you can use a variable interest rate up to 6%. So what do you want to actually get return on the funds that you're putting in to that plan to fund those benefits? You really want to get kind of the same return. You want to get somewhere in the neighborhood of 5 to 7% return on those funds wherever they're invested. This is not a place to really play roulette with investments, because if the client invests the money and gets a much higher return, that will reduce the future contributions, because our end point, the final benefit that will be paid, is defined by the document, not the performance of the underlying assets. So if we've earned more than expected, we'll have to cut back our future contributions. Conversely, if they invested and they lose money, next year they're going to have to contribute more to make up for that loss to keep that plan on track. So typically we see these plans invested in a conservative type portfolio, looking for about that 5 to 7% return. So good candidates for these kind of plans. We do these in owner only, so we do these in one-person plans, but also companies that are kind of naturally tiered are a good match for cash balance. Think of medical groups. You know, you have your receptionists, your technicians, your PAs, your nurse practitioners, your nurses, your doctors. Everybody's kind of at a different professional level. Law firms can kind of be the same way, right? You have clerical and paralegals and junior attorneys and senior attorneys. And so when you have companies that have that kind of layering, we can design a plan that mimics that employee layering, if that's something they would like to do, so the benefits sort of make sense in the way they tie into the layers of employees. Other good places to do this are if we have a company where we have older owners and younger employees, that would be ideal. But even when we don't, we have enough control here to kind of even things out pretty much in more ways than we could in other kinds of plans. We can do almost any size group here, depending on how many people we're trying to favor. Obviously, if the owners want to be favored, relatively speaking, the ratio between the owners and the employees will make a difference. But you know, we do a lot of these plans that might be 250 employees. We also do one person cash balance plans, so they kind of can run the range. It all depends what the group looks like. Looking for companies with cash flow and looking for those bigger deductions. So, you know, consultants, hedge funds, IT, financial services, any company that has the cash flow is looking for those bigger deductions and has some consistent income. So profitable businesses that have a track record, certainly professionals like the doctors, the lawyers, the veterinarians who have kind of constant cash flow become good candidates here. This is an obligation to make a contribution. So they are, you know, committing to making this contribution for at least a minimum of 3 years, ideally at least 5 years. So we'll stop for a polling question.
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who has yet to select an answer. The poll is now closed. The correct answer was B. Mary, you may continue.
Thank you. Okay, so let's talk about the Secure Acts, right? We've had 2 so far, Secure Act 1 and 2. We're hoping there won't be a number 3. Maybe they'll come up with another name, but we don't know yet. So these acts made quite a few changes that do affect qualified plans and qualified money, including required minimum distributions that people have. So here are just some of the highlights for qualified plans. Non-governmental qualified plans have to be amended to comply with changes here by the end of 26. Collectively bargain plans have 2 years longer to bring these things into their documents. They have until 28. And governmental plans have until 29. So depending on what kind of employer and what sector they're in, will control when they have to have these amendments adopted and implemented. For Section 403B plans, non-public school 403B plans have till December 31 of 26. The collectively bargain plans of tax-exempt organizations have until 28, and public school 403B plans have until 29. The deadline for the eligible governmental plans is the later of December 31, 29, or the first day of the first plan year, beginning more than 100 days after the date of the notification regarding inconsistent administration with Section 457B. That is such typical IRS language. You know, it's the later of or the lesser of. So you can see there are delayed dates here, but they're not as far off as it seems. December 26 will be here before we know it. Some of the provisions are effective now. That's when documents have to be amended, but some of these provisions are already effective. So the employer Roth contributions allows defined contribution plans, so that would be 401k plans, profit sharing plans, to give participants the option of receiving matching or non-elective, employer contributions as Roth contributions rather than as pre-tax money. The self-corrections programs that the IRS offers for plans who have errors in them was expanded. EPCRS, which is one of them, was expanded for more self-correction, including correcting inadvertent IRA errors and certain RMD failures. one of the things that they offered, if you fail to take your RMD in the past, the amount you should have taken and didn't was subject to a 50% penalty. They've now reduced that to 25%. That's just one of the changes. And they also increased the startup credits for businesses who are adopting a plan for the first time. They can get a credit to help offset their startup costs to do that. This is for plans with fewer than 50 employees. They increased the startup credit from 50% to 100%, up to a maximum of $5,000 for the first 3 years. Plus, it gives an additional credit for employer contributions to defined contribution plans of up to $1,000 per employee. So they're making an effort here. They're giving these credits for the first 3 years to help encourage employers to set up these plans by kind of helping them over the hurdle of the expense of setting them up. So it's a good thing for employers to take advantage of. Small incentives, this I thought was a surprising one. Sponsors can now give some kind of financial incentive to their employees to encourage them to defer in their 401k plan, like a gift card. That was never permitted before, so that's something very new. As I said, they reduced that RMD penalty down to from 50% to 25%, and it can even be reduced to 10% in some instances where it's corrected quickly. The required minimum distribution age, this was one of a lot of controversy. You'll recall it used to be 70 and a half, and then it was moved to 72. Now it is 73 for anybody who was born before 1960. And for anybody born in 1960 or later, it is now age 75. For SEPs and Simples, it allows Roth contributions now to be made to simple IRAs. And permits employers to allow employees to treat their SEP contributions as Roth also, right? So anytime someone elects a Roth contribution rather than the pre-tax, it will be taxable to them today, as opposed to the pre-tax, which is not. But as a Roth, assuming they comply all the way along to when they ultimately take the money out, all that growth and their income in the future will be tax-free on that money. Starter 401ks are a new kind of plan that was created by the Secure Act. It's a simplified 401k, and we haven't seen it take off too much yet, but you never know. It has lower deferral amounts, simpler structure, and also a safe harbor 403b plan was offered for employers that don't have a retirement plan. The emergency savings accounts, this is to give non-highly compensated employees the option to have money in these emergency savings accounts that they can access with optional auto enrollment of 3%. The cash out limits, when an employee leaves, especially if they haven't made an election, you can now automatically cash out up to $7,000. That number was at $5,000 for a long time. And there was some question when we have Roth accounts in a 401k, they were subject to required minimum distributions. A Roth IRA is not, by the way, but they were, so they fixed that and now eliminates that RMD requirement on the Roth accounts. This was a new one. For employers who have simple IRAs, the challenge was always if they decided they had grown or whatever and they wanted to move to a 401k, you could not move to a 401k until the next year because you cannot have any other plan in a year in which you have a simple. They created a new rule where that employer with the simple IRA can now move to a safe harbor 401k plan if it meets some requirements. So that gave some new flexibility to those employers to step up to a 401k plan. This is a new requirement that all catch-up contributions made to a plan for employees with compensation over $145,000 must be Roth. Cannot be pre-tax, they must be Roth. And on the rollover side, we now have rollers from 529 accounts in place for at least 15 years that can now be rolled to Roths, subject to a lifetime limit of $35,000. So that's a new provision as well for those 529 accounts. Auto enrollment is a big one hitting all the employers across the industry. We now have auto enrollment required in 401k and 403b plans. This is the government's way of trying to get people to have more individual retirement savings. We got higher catch-up limits. They went up a little bit for retirement plans that apply at age 60, 61, 62, and 63. Long-term part-time employees. This has been around for a few years, and they just they reduce the eligibility here, basically expanding the provision. Long-term part-time employees are people who don't work enough hours that they would typically come into the plan, but they stay with that employer year after year. Now they have to be allowed into a 401k plan to make salary deferrals, and they reduce the 3-year requirement of employment to 2 years. The DOL updated regulations for performance benchmarks for asset allocation funds. This would come into play in some of the funds in the 401k. And long-term care insurance payments. Again, now retirement plans can distribute up to $2,500 per year to pay premiums for specific long-term care insurance contracts for participants. This is to meet a growing need for long-term care protection in this country as the population ages. So this was kind of a grace for people to access money and be able to take it out without the 10% penalty. Group plans. So we have some new group arrangements that were created by the Secure Act, and these started with plan years. Look, this is all the way back to 2021. This has been with us now for a while. So a group of defined contribution plans may file a single 5,500 if they use the same trustee, same name fiduciary, same administrator, same plan year, and same investments. So they could be individual plans, but if they have all these things in common, they can all file together on a single 5,500. So that's an effort to reduce their administrative expense for those filings. We have MEPs, both multiple employer plans, which is a single retirement plan in which one or more unrelated employers participate. So it's one plan, but multiple employers are in it. These have been around for a while, but the Act streamlined some of the administrative requirements to make them more economic. There are two types of MEPs. MEPs could be a group where the employers all have something in common, like they're all part of an association or a professional organization. And then we have open MEPs, which are unrelated employers who just come into this one combined plan. A new term is pooled employer plans. These were created by Secure Act 1. They became available as of 2021. This is a little different than a multiple employer plan. These can be unrelated employers who participate in a single plan that is specifically sponsored by a pooled plan provider that has to be registered with the IRS and the Department of Labor. It has simplified reporting and compliance rules, the no more one bad apple rule. One of the fears when you have multiple employers in one plan is, what if one employer falls behind on their contributions? Does that ruin the whole plan, or the other employers on the hook for that? This got rid of, cleaned up that rule a bit to make it kind of a little more comfortable for employees to enter into these arrangements. So a little more on the startup cost for these employers with less than 50 employers. The tax credit, again, went from 50 to 100%, capped at $5,000 per year, available for the first 3 years. So that could, they get it all 3 years. And if they're making contributions for the employees, not just salary deferrals, but employer contributions, they can also get a per employee credit for doing that. And they now apply. You couldn't get these credits for SEP, Simples, and 401ks, but you now can. But you have to look at how many employees. There are different rules if you have 51 to 100 employees than if you have these less than 50 rules. And these have been around for taxable years beginning after 22. The military spouse credit, this is something new either. Small employers get a tax credit for their defined contribution plans, such as a 401k plan, if they allow military spouses in the plan within 2 months of hire instead of the standard eligibility. Make military spouses eligible for any matching or non-elective contribution they would have been eligible for otherwise at 2 years of service, and grant immediate vesting in those employer contributions. So a much more generous stance for those military spouses. Again, the employer can get a tax credit up to a maximum of $500. The credit is for 3 years. There's a certification here. Right now, the IRS is relying on the employers to self-certify That might change, we don't know. And this became effective with 2023, years beginning after 2022. That small incentive for contributions has to be less than $250. So, you can't pay somebody $1,000 to encourage them to defer, but you could do a gift card up to $250. These starter 401k plans, these became effective in 24. Permits an employer without a retirement plan to offer these starter plans, would have to be their first plan. It calls for auto enrollment at a rate of anywhere between 3 and 15%. The employer could pick what rate they want to do, but it is auto enrollment. And as I said, deferrals are limited here. They're lower than a 401k or a traditional 403b. They're limited to $7,000. And the catch up for those 50 and older is only $1,000. But the idea here is that it is a simplified plan, easier to operate. So more on those long-term part-time employees who now have to be eligible to enter the plan after 2 years of service. A year of service here is counted as 500 hours. Pre-21 service can be excluded. If the eligibility does not occur by 24, then the pre-23 service is excluded. That's kind of a technicality. It's still, we can still have an age 21 requirement. So if you have an employer who hires high school kids or whatever, it doesn't apply. And what it means when they come in the plan is they're eligible for deferrals. The employer does not have to make employer contributions for them, even if there are employer contributions in the plan. This is just to allow them access to make deferrals. Student loans, right? We know that student loans are a big problem in this country. So now there's an option where employers can choose to do matching dollars to match qualifying student loan payments in the same manner as employee deferral. So it would be a match, just like you would have a match on deferral, but now it's a match on a student loan payment. There has to be some kind of verification process in place, and there's still some debate about that with the IRS. And of course, it has to be tracked by the administrator. This has been around for a while, actually. So if you're a sole proprietor and you get to December 31, right? If you're in a 401k plan, you must make your salary deferrals by December 31 off your last paycheck. But sole proprietors don't get a paycheck, and they don't even know what their compensation is until they do their tax return. So the IRS officially granted an extension for sole proprietors and single member LLCs that they may make their salary deferrals up until they file their tax return. And that took effect in 23. The Roth, we talked about this, right? You can now have Roth contributions in simple IRAs. You could have Roth in SEPs if the employer elects it. And this became effective in 23 as well. The option to treat those matching contributions as pre-vested or Roth became effective in 23 as well. We finally got some guidance in 2024 that had been waiting for. Some of these items are still waiting for guidance that made this clear as to how to implement it. So this is now live. So our next polling question.
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who's yet to select an answer. Okay, the poll is now closed. The correct answer was D. Mary, you may continue.
Thank you. All right, so let's talk about the state mandates. There's a lot of activity here. There's been a lot going on. And so there have been a lot of the Secure Act changes, and a lot of recent legislation in the qualified arena has been focused on increasing savings and participation for regular employees, not the business owners, but the regular employers. And so there has been a lot of activity at the state level to create programs that are mandatory for these small employers to adopt if they don't have a true qualified plan in place. So in some of the states, these are already up and running. And some of them, they are still in development, and some of them, they are still in discussion, and there are some states who don't have them at all. So this is an ongoing process, and there continues to be activity. The starter 401k that we briefly talked about, as I said, with those lower rates, that was created kind of as on the federal level as an alternative to these state mandates. We have not seen in the industry a lot of activity around that yet. Oh, of course, that could change. And the state mandates are something of a challenge because they are different in every state. Every state is taking its own view. And you can see from this map here, the blue states, the legislation has already been passed, and those plans are active. There are some state programs. Some are IRAs, some are 401k lookalikes. They vary from state to state, but you can see all the blue states there already have these plans up and running. The ones that are in kind of that yellow gold color have introduced legislation in the last 10 years. It hasn't passed yet, but it is sitting there being discussed. The pink ones, it has been passed, but it just hasn't launched yet. So those states are coming. And then you can see just the gray states. It's only 2 states that have no legislation under consideration. So 2 out of all the states, I'm sorry, are the only ones that aren't looking at this and planning to implement something. I'm sorry, there's 3. South Dakota is in there also. So that's as of this moment. And so this is an ever-changing picture. What we have been hearing, and what has certainly popped up in the states that have implemented these mandated programs, a lot of the employers don't like them, but also a lot of employers are looking at adopting a custom design plan, you know, what I call the true retirement plans that we've been talking about today, rather than the one the state is enforcing, because if they're going to have a plan, they'd rather have one they want than one that's forced on them. And if they have their own plan, then they're exempt from the state requirements. All right, so now let's talk about liability. Not everybody's favorite topic, but when an employer adopts a qualified plan, they have responsibility for that plan. And they are trustees. Usually the business owners frequently will be the trustees. And as trustees, they are personally liable for that plan. So there are a lot of elements that come into place for this. There is the operation of the plan. There are the investments of the plan. So some of the elements of the governance, they're responsible to select and monitor plan service providers. You can't just hand it off to somebody without checking them out. Oversee the plan investments. There are requirements as to the quality of those investments. They need to be monitored to make sure that they are all good performing investments. You're not letting dogs sit in that plan. Operate the plan according to the governing documents. There's a legal document that creates every qualified plan, and the terms are in that document, and they need to be followed, as well as all the laws and regulations that govern qualified plans. This is a highly regulated area. Documents have to be kept up to date, as we could see just from the Secure Act. There are always changes going on, and then with time, those changes have to be implemented and amended into the plan documents. Ensure fulfillment of reporting and disclosure requirements. There are several reporting requirements and disclosures to employees that always have to be followed. Avoid or mitigate conflicts of interest. You cannot have self-dealing. You can't have a trustee of a plan self-dealing and choosing to invest in something that personally benefits them, for example. Build and maintain a document and document a plan. There should be a plan, of course, as to how the employer is going to do this. How are we actually going to keep track of all these things? Ensure governance team is effective and has appropriate educational opportunities to understand what it is they're responsible for and how they're going to be held responsible for that. So 316 services. What is 316? 316 is a code section, Department of Labor, where those fiduciaries can offload some of this responsibility to a professional. So the Department of Labor recognizes that fiduciaries will almost certainly want to hire service providers when they find out, especially when they find out they're personally liable. And they don't have time, lots of times, to really focus on these things. So there are companies that offer what are called 316 plan fiduciary services. And what that is, it's an individual or an entity that is named by the plan administrator. The plan administrator is an official position, just like plan trustee, typically the employer, and agrees to take responsibility for all the daily operations of the plan. So when a plan hires a 316 plan fiduciary, they're handing over operation of that plan. That 316 fiduciary is now responsible for making sure all the compliance work is properly done, all the reporting is properly done, the documents are properly done, and taking the responsibility for that. So if something goes wrong, it is on their shoulders, not the employer's. This has become more and more popular in recent years as the cost of these services have come down. And it can simplify the work for that employer because now it takes a lot off of their plate, off of their human resource person, where they may have had to spend time doing these things. Now their time is freed up to do work for the company rather than working on the compliance of the plan. So a delegated 316 plan administrators, it's really an outsource of the HR function that saves them time. So by hiring a 316, it will save time at the company, it reduces their liability and frees people up there to do other things, and also makes it much more likely that all those things will be properly done. So here are just some of the duties that would be provided by a 316. Let's start at the top here. Audit assistance if that plan is audited. Distribution services. We have to compute what someone's going to be paid, how they're going to be paid, when they're going to be paid, and you have to do reporting on that payment. Plan document services, keeping that plan document in compliance as laws change. Participant notices and disclosure notices. There are requirements of information that have to be given to employees and reporting to the government. Participant management services, again, keeping track of that information, and government reporting services. Lots of people are familiar with Form 5500. These are all things that the 316 administrator fiduciary would take on. So, this has become, as I said, a more and more common choice, and more employers are turning to these 316 services just to make their day more efficient, free up their time, and reduce their exposure to liability. And as I said, these services have become much more cost effective over the years that they've been available. Now that's what's called 316. You may also hear about 338. This is a plan investment manager. So 316 is the operation of the plan. 338 is the investments of the plan. When a 338 fiduciary is hired, they will have full investment discretion over plan assets. It will be an RIA, a bank, or an insurance company. They will be appointed, and they must still be monitored by the plan sponsor. It doesn't take it 100% off their plate. They still have to monitor them. This deal would be put in writing. And now that 338 plan investment manager is responsible for all investment matters, including selecting the appropriate investments and making sure over time that you're keeping the appropriate investments in that plan. All other plan fiduciaries relieved of fiduciary responsibility for the investment decisions. They're by the investment manager. So that's a serious one. So how do you select a 338? Obviously, you want to look at credentials and their history and evaluate them. Look at their fees. This is this tends to be more expensive than 316. So you certainly want to do an analysis of their fee. Look at their service agreement. What exactly are they going to do for that fee, because not everybody's exactly the same. And then the employer still has the responsibility to monitor them. Polling question?
The poll should now appear on your screen. This poll will be available for another few seconds for anyone who's yet to select an answer. Poll is now closed. The correct answer was D. Mary, you may continue.
Thank you. All right, so let's just get into a couple of more remaining, we have a couple of things still to talk about on our points. So one is key employees. How can we take better care of key employees? When we do qualified plans, we have to consider all of our employees. But if we just want to take care of a select few of employees, then we're talking about some kind of non-qualified arrangement. So they can come in a variety of types. So pay as you go. Might be an IOU to pay the employer from a business balance sheet. That would be paid from working capital. And this would typically be in companies that have high growth. Sinking fund, managed accounts, mutual funds or stocks that are holding the money. The gains and earnings are taxable to the business. That method of funding would typically be companies with a high tax rate. And then institutional, we have group insurance, COLI, BOLI, that's corporate-owned life insurance, bank-owned life insurance with cash value, where generally the gains are not immediately taxed because these are insurance vehicles that are being used now. In the other two scenarios, growth on the money that's kind of being earmarked to pay these benefits is taxable to the company. If you're an insurance product, it is not. And so these do become popular tools for these kinds of arrangements. So it's different for pass-through entities to do these kinds of arrangements because we want some tax differential here to gain advantages. If it's just passing through, you're kind of just making it more cumbersome to end up in the same tax position on compensation. So to pass-through business entity is not treated as a separate taxpayer. And so earnings and losses pass right through to the owner, who has to report them on their personal tax return. So for example, if we're talking about a deferred comp program, a comment talked about executive bonus, you can't do a deferred compensation if you're a sole proprietor because it just passes through anyway. There's no entity to defer it to, which there would be in a C corporation, which would then hold it and pay it to you later. Contributions to non-qualified plans are not deductible by the employer until they're paid to the participant. Unlike a qualified plan where the money is deductible the day that it goes in. These are not deductible. However, the business will get a deduction when the benefit is ultimately paid. Earnings on non-qualified plans are taxable to the employer as they accrue, as I said, unless they're using those insurance products and structured in a way that it's not. And you always have to look at the tax consequences here. For the business owner and also the recipient if it's not a flow-through business. Now, an S corporation, for example, let's say they had $10 million of revenues and $9 million of expenses. So they've got $1 million of profit, right? For a key employer, the owner makes a $250,000 after-tax contribution to what's called a rabbi trust. That's a way to do a non-qualified plan. The contribution is reported as taxable pass-through earnings for the owner, right? There's no deduction there. The rabbi trust earns $10,000, which is additional taxable income for the loaner. So they side moved the money, but they didn't get any tax advantage there. But if they were a C corporation and did it, they would gain a tax advantage because that would go into the rabbi trust and would not be immediately taxable to them. So there are lots of variations in the non-qualified planning world to be looked at and considered. They are typically implemented by corporations that don't have pass-through, so typically a C corporation. So lastly, let's talk about how do I get my employees to be more motivated, be more productive. Qualified plans can help as a tool to do that. As one way, right? You're rewarding employees for staying, but also employees need help with financial wellness. I know there are all kinds of studies that find that employees they don't know how to invest the money. So here are some statistics. 74% of employees would like help with their finances. That doesn't mean they're getting it, but they would like to have help. Only 27% of plan sponsors surveyed offer a comprehensive financial wellness program at work. So there's a big differential there. Financial wellness programs have the power to establish a more satisfied, engaged, and productive workforce, right? If you can help your employees to be in a better financial position, usually that makes people happier. They appreciate the value. It helps attract employees that you're offering that service. And also can help just plain productivity. If people have more money to be able to make more choices. Maybe when a child needs care because they're sick, maybe they can pay for someone to care for them and still come to work rather than having to stay home. And these are becoming increasingly adopted by employers, these kind of financial wellness programs. So some resources to get information about, you can see on the screen here. These are some places you could go, and you'd be able to access this. If you can always access the presentation later to get more information about these programs. So with that, I think I will wrap it up. We have a few minutes left. I'll be happy to take questions.
I think we are all set, Mary. I don't see any questions right now.
All right, so I thank everybody for your attention. If you do think of questions afterwards, I believe you could email to us and I will try to answer them.
Perfect. Well, thank you, Mary, and thank you everyone who attended today's webinar. As a reminder, please complete the survey questions that will pop up on your screen in just a minute. And everyone have a great rest of your day.